Hello. Today I have with me Andrew Bell, Chief Executive Officer of the Witan Investment Trust. Andrew, thank you for joining me today.
Thanks for having me on.
Witan is a dividend hero, having raised its dividend for 46 consecutive years. How key was the investment trust structure to enable the trust to continue that impressive track record, given the dividend drought that played out last year?
I think it was central, and it was one of the years when investment trusts' ability to smooth dividend payments by using carried forward revenue reserves really did come to the fore, because it's comparatively rare to have actual falls in market dividends, and so for most of the time all kinds of funds can carry on raising their dividends. But I think last year was one, and 2009, the year of the financial crisis, was another. Last year we had the double whammy of the scything of UK market dividends especially, as well as a shift to a lower yielding portfolio in the wake of our change to a more global benchmark. So having over 1.5 times a year's dividends in revenue reserves retained from earlier years, we were able to deliver that further year of dividend growth as a result of our ability to use those past reserves to cover the years of drought. And we finished 2020 with approximately 1.25 years worth of dividends in reserves.
What's your outlook for dividends going forward?
Well, dividends in the early part of 2021 stayed relatively soft because companies were effectively reporting for the full year 2020, which was still a very difficult period, for not as difficult as the first half of the year, but it was still, many companies were still under the cosh, in some cases not able to open up at all. So as companies were reporting on a difficult 2020, in some cases there were still follow-through cuts in dividends from companies which had actually paid higher dividends in the early part of 2020. But since April, the trend has been positive. Companies, as they can see their earnings picking up as economies have reopened, have been reinstating or growing dividends. And I think the forthcoming interim reporting season will be particularly interesting because it'll be the first confirmation of how the economic reopening is flowing through to an earnings and dividend recovery for companies. And the regulators in the financial sector, for example, appear to be taking a more relaxed attitude towards banks being allowed to pay out dividends. They could have paid out dividends last year, but were prevented from doing so. So I think, taken all together, there will be substantial growth in dividends for 2021 as a whole, but it'll be from a relatively flat start carried over from last year. And I think we may have to wait till early 2022 to see the full juice of it. In the medium term, we expect our portfolio to re-establish the pattern of relatively fast dividend growth seen in 2010 to 2019 because of the nature of our portfolio. And we see our dividend cover rebuilding. And the board has made clear that we're willing to continue to use our revenue reserves to support dividend growth while that process happens.
Witan has around 10% of its assets in other investment trusts. Could you run through your 3 biggest holdings and the investment case for each?
Yes, actually, by coincidence, all 3 of the largest holdings are listed private equity funds. And that's partly because it is an area which is uniquely well represented in the investment company sector, and our regular equity managers tend not to buy into that area because they're buying normal PLCs in the market. So the top holdings are Apax Global, Alpha, Princess Private Equity, and Electra Private Equity. Apax we've backed since launch, I think sort of 7 or 8 years ago or more, and it is our biggest holding. It's an investment group which tends to focus on relatively high growth areas such as information technology and healthcare. And over the last 2 or 3 years, its NAV growth has begun to accelerate. And on the back of that, they've moved from a fairly significant discount to a level close to or around NAV. And they also pay out approximately 5% of their NAV gains in dividends to shareholders, and in that they share a characteristic with Princess Private Equity, which has been going for a little bit longer, and which is run by the Swiss Group Partners Group, and which has a very long term track record, as Apax has, as a strong marking name in the private equity sector. And Princess also pays out a proportion of its total returns over time in the form of a dividend. And the attraction of that for an investor is twofold. Partly, it's immediate gratification. You're getting some reward for holding the stock, but also it avoids the feast or famine thing where where private equity funds tend to get a lot of realizations as the cycle matures, and it's quite a good discipline that they have to redistribute some of that money to shareholders to avoid having too much money burning a hole in their pocket and making bad deals. The third, and those are both fairly diversified portfolios and with an accent on companies with pricing power, long-term growth prospects. The third is quite different. Electra Private Equity, we bought back into in 2017. It's a portfolio we knew well because we'd held it for much of the previous 5 or 7 years. And it appeared to us to be relatively lowly valued, and it was into a period of where the portfolio was being realized and the returns being paid out to shareholders. So we bought into it as a cheap, if you like, runoff situation. Progress was rather rudely interrupted in 2020 because the two main remaining holdings were Fridays, the casual restaurant group, and Hotter Shoes, which is a shoe retailer. And those were not exactly a dream portfolio in a year when the economy was in lockdown. But both of the companies managed to come through that process. And recently Electra announced that they were going to list Fridays on the UK stock market, probably in the current quarter. And Hotter Shoes has pivoted from being a high street chain to being predominantly online. And as a result, the shares in that particular company have doubled this year because it's clearly it's been a very concentrated play on a recovery in the UK economy.
The overall top holding is a climate change fund. Has Witan been increasing its focus on ethical or sustainable investments?
Our prime motivation is to deliver good returns for shareholders. And although there's been a lot more debate over ESG and ethical investments and the whole spectrum of things, people have different interpretations of what it means. Good governance, social responsibility, and proper risk management are an integral part of investment management and have been for many years. What's really changing is the greater formality in engaging with managers and our managers engaging with their investee companies on these issues to hold them to account when they fall short, and a degree of improved transparency in reporting on these issues to shareholders. Another thing that's particularly changed in the last couple of years and is likely to come into greater focus in the next few months with the UN conference on environment change in Glasgow in, I think, October, is the environment part of ESG has gained much greater prominence, and for good reason. We've had a holding in the GMO Climate Change Fund since 2019 and recently added to it. It's almost 4% of our assets, so it's still a minority on its own, in addition to which we've made an investment in a sustainable energy fund, so nearly 5% in total in investments specifically targeted to assist with efforts to mitigate and adapt to the problems of global warming. We are pretty sure this is going to be an enduring source of growth, both economic growth, because it's an increasing political priority to spend money on trying to tackle the climate change issue to avert the worst consequences. But we also think it's going to be a great source of returns in the decades to come, and it's attracting increasing attention from us. We also formally engage with our managers regularly to ensure that they take full account of the regulatory, reputational, and indeed in many sectors, obsolescence risks in their portfolios. Obsolescence can come from technological obsolescence, sort of Amazon putting whole sectors out of business, or it can come from the stranded assets worry that a lot of oil reserves will end up being left in the ground because the world will find something else, will find another way of generating electricity before it actually runs out of oil. But it's important that our managers take account of all of those risks in justifying why they hold particular companies. And we're also a signatory to the UN Principles of Responsible Investment, and we'll be publicly reporting on our compliance with their goals from 2021 onwards.
And finally, do you have skin in the game? And how important do you think it is that a fund manager invests in the fund or investment trust that they manage?
I think it is very important. You don't poison people if you eat the same food. My personal holding is disclosed in the annual reports, and having doubled in value since purchase, it's worth more than 6 times my annual salary. So I share both pain and pleasure when the shareholders do.
Andrew, thank you for your time today.
Thank you, Carl.